You don't have chips there, chip funds there. Right, coming down to this. There are some investments which have a comparatively less risk and they give you less returns. Now, which are the ones that you consider risky? Share money. But do you know they are the ones which give you the highest returns? They are the ones which give you the highest returns. Only thing is, pardon? Yeah. Why is there a risk in stocks? Because you have not understood that. Why is the risk in stock higher than the risk in a fixed deposit or a bond? Why do you think? Have you ever thought of it?
Because you are not in the corporate decision making, you are just investing into that company without doing a deep analysis of what the company does, how it operates, how it makes decisions. See, I'll tell you, analysis is only a small part. Because most of the time, when you do an analysis, it always ends in a paralysis. The more you analyze, the more paralyzed you get. At some point, you have to take this. Basically, if you are investing in a company, and remember, the future of the company is not. You may do analysis. What is the analysis you are doing? What has happened? You are only becoming a pathologist. Why did that person die? You want to only see. Or why is that person alive? But you are not looking at how is he going to live healthy. Correct? Because of that uncertainty of future, company stocks are normally. Again, even in bonds, now he said bonds. Bonds, do you think are safe? To a certain extent, as long as the government opinion exists.
I'll tell you. Argentina government existed even in 2001, right? But the bonds were neither redeemed nor was the interest. We have now reached, they call it as PIGS. I don't know whether you've heard of it. What is PIGS? Portugal, Italy, Greece, Spain, as well as to a certain extent Ireland. Just like that new Fiat Sunny advertisement, Nissan Sunny advertisement, car, like that, pigs, double line. But now there's every possibility of Greece not paying their debts or the interest. What has happened to the depositors in US in 2008, 2009? They've lost. So here you are thinking it is safe, but even today your deposits are safe to the extent of
1 lakh.
only 1 lakh, that too including interest. Otherwise, no. Right? Yes. Now risk and return can be balanced. You need to take some risk for a higher return. Why? Exactly. To beat inflation. If you keep going in a bank deposit itself, and at times, you know, inflation will be higher than the returns, and at times inflation will be lower than the returns. How long it is going to be, no one knows, because you may travel in car, but all investment travels in cycles only. They all go in cycles. And the cycle is such, when stocks are up, possibly the fixed deposits will be at down, and when the vice versa also. So naturally, what is it you should be doing?
Also riding the cycle.
Yeah. Which cycle are you going to ride? Now that's another problem. Which cycle are you going to ride?
Higher cycle.
No. Then you will never earn anything. The reason is, you think you are riding the cycle which is higher. Naturally, when it is high or when it is at the top, the only way is down. So you have lost that. By that time, the other cycle has gone up. So you are going to shift there. Again, what's going to happen? Down. So what would be our alternative? Go for a mixture of all kind of assets. And allocate some amount here in fixed, allocate some in some risks you have to take. in life you have to take risks. How many of you don't like to travel by airplane? Everyone likes, right? Now you know when you go by flight, where is the maximum risk? When it is in the air. You take the risk. You take the risk. Same way, you have to take the risk. Otherwise, it's like, you know, you wanting to go from Bangalore to Bombay in a plane, but without any risk. That means it has to never fly.
Even on board also. It's not so.
Right. Now, coming to this, you have to allocate your assets. Investments are to be allocated. How do you allocate? You need to do it in such a way. There's a thumb rule. What is the thumb rule? Whatever is your age, put that in fixed. So how old are you, sir? 31. So around 30 to 31% should be in fixed deposit. Where should the others be? Normally the risky ones. Which are the risky ones? There and the stocks. But is it the case with you? Now, what if you look at the formula, what does it say? Younger you are, you need to take higher risk. Why? You still have time to make up any loss that you might have. Imagine a 60-year-old person having 60% in stocks and 40% in fixed, and stocks go down by about 30-35. What is going to happen? That will be the maximum age he would have. Not probably. If he has a weak heart, right? So you need to basically look at an asset allocation, follow it. Just following asset allocation, will it help? There are other things also which you need to look at. If you look at stocks, will you invest in stocks if I advise you? No? Why?
Everybody thinks he's the smartest.
No, that is always done. That is always done. And particularly if you have access to net, then you think you are the unbeatable smartest person in the universe. Right? Okay. Now you said you are not good. Why?
I don't know anything about it.
Don't know anything about the stocks. Okay, fine. You are not good interested. Mutual funds. You know, again, they are again stock based. So will you again now, if tomorrow he advises you to invest in mutual funds, will you invest? Considering that the navy is going up and down. In fact, if you invest in stocks and mutual fund, you don't need any CT at all. If you are looking at the prices every day, that movement, that graph, hold it in front of the mirror, that's your research. Because when the price goes up, the BP comes down. When the price goes down, the BP goes up. So exact opposite goes up. Now, why is it you don't? Or why is it you will not? What do you mean risk? Okay. Whether the principal will come back or not. Now, coming to this, all the riskier investments, whether it is stock or mutual, you are looking at, you put your money today, you are looking at it. Tomorrow, no. In all probabilities, you would have lost. Now, you are in business or business. Now, you keep looking whether the sales have gone up and down on a daily basis or on a monthly basis. Monthly. Look at it on a monthly basis. Here also. For that risk, what you are taking, you are looking at it monthly. For this, what you are putting in, you are looking at it daily. Is it worthwhile? Now, every day morning, the first thing you look at the NAV, it is down. What will happen when you go to your business? That mood, oh, yesterday I put in, today it is gone. So that mood, your business is also going to go up. Isn't it? So don't look at it on a day-to-day basis. That is because, remember, these riskier ones give you a only when your time horizon is long. Time horizon is long. In 79, when I joined, first thing I did was, one of the first investments I did was in Reliance. I bought it at 18 rupees. Today, do you think that 18 rupees what I put per share, am I going to lose? Even if the market comes down by 50%, am I going to lose whatever? But then, if you look at the time horizon, I have reached that stage when, after a period of more than 5 years, 10 years, normally you move. Only thing is in the short runs, but also again remember, if you look at statistics, since it goes in cycles, there may be periods when